Hi guys, welcome back to Father and Son Investing. Today's video will be for I-bond investors. If you are an I-bond investor, you may be paying close attention to the CPI numbers and yesterday's producer price index number. Both of those that just came out recently are indicating that inflation is declining. And what does that mean for your I-bond? I think quite possibly your I-bond will be getting 0% interest now for the inflation portion of your I-bond interest rate. So today we're going to talk about some alternatives to I-bond investing. At least we're going to start a series of videos. This video will talk about CDs. We'll talk about both the bank CDs and the brokered CDs as potential alternatives to I-bonds. If you're interested in this topic, go ahead and continue to watch. If not, at least you'll know that CDs are a potential alternative. All right, for those of you that are still around, let's go ahead and talk about CDs. No, we're not talking about compact disc. We're talking about certificate of deposit. Before we get to that, though, I want to show you how I arrived at the I-bond inflation rate being 0% or potentially even negative. So let's go ahead and walk you through that really quickly, and then let's talk about CDs. All right, if you've seen any of my videos before talking about I-bonds, you've seen this spreadsheet. For those of you who haven't seen it, this is just data for the consumer price index, or the CPI for all urban customers. Sometimes you'll just see that as CPI-U. Now this goes all the way back to the 1980s. I'm not going to show you that, but essentially just know that 1982 to 84 was marked as 100. So that if you look at the numbers now, we'll take December's number of 296.297. If something cost $100 back between 82 to 84, it would now cost $296.80. That gives you an idea of how these numbers work. Now, if you're familiar with I-bond semi-annual inflation rate, you will know that the months that count are March and September. Those are the only 2 months from which they figure the I-bond inflation rate or the semi-annual inflation rate. Nevertheless, we can track the month-to-month numbers to get a rough idea of what the I-bond inflation rate portion of your interest rate may look like. So I've got here October, November, and December of 22, and the numbers here, as well as the month-to-month difference between the CPI. We'll see that in October it went up to 0.4, but essentially the last 2 months have negated that. So we're looking really at 0% so far, semi-annual inflation. And this number out here will tell you that you can calculate it by doing this simple formula that I have listed here that you can see, and we're coming out at essentially 0% as well. It's actually slightly negative. What does this mean? That means if nothing else changes, if this were to just hold at 0% on the month-to-month numbers, your I-bond inflation rate will be 0%. However, given this downtrend going on here, I think it's quite possible that your I-bond inflation rate could actually be negative. Now, what does that negative number mean? It means that it could offset the fixed rate. For those of you who bought I-bonds after November 1st, you have a 0.4% fixed rate, but that is not a guaranteed minimum. If you don't quite understand that, I did a video previously about that, and I will include a link to that so that you can see how potentially your 0.4% is not a guaranteed minimum, and you could still end up with earning 0%. With that background in mind, let's just go ahead and talk about an alternative to I-bond investing in order to increase the amount of yield that you can get for 2023. We're going to talk about CDs, not the music CD, but a certificate of deposit. How does that work? It's quite simple. There are 3 steps here. You're going to put in a lump sum of money. Now, know that there can be minimums. Some might be as low as $50, but you could be seeing a minimum of $25,000, depending on what type of CD you're getting into. You're going to wait a specified period of time, 1 year, 5 years, 7 year. You can even see them longer than that. And when that amount of time is over, you can withdraw your money plus interest. That's how it works. 3 simple steps there. Now, nothing is ever quite as simple as it sounds, and it works that way with CDs. There are actually various types of certificates of deposit. We're going to talk about 2 types today in today's video. We're going to talk about bank CDs first, and then we're going to talk about brokered CDs. Bank CDs are what I just described to you in those 3 simple steps. Note that there can be an early withdrawal fee to take money out before maturity. That's how the bank guarantees that they will get to use your money for the duration of that certificate. Bank CDs are FDIC insured up to $250,000 per depositor per FDIC-backed bank. So if you have reached that $250,000 limit, you're going to have to go to another bank to establish another CD at that institution, or run the risk that should the bank fail, you would lose money beyond the $250,000 FDIC insurance limit. Now again, as I stated, nothing is ever quite as simple as it sounds. There is something called an add-on CD where you can actually add money to a CD over time. So you might start with a minimum deposit of $50, and over time you can continue to add money to that CD, similar to a savings account, knowing though that you still would pay an early withdrawal fee if you took that money out before the maturity date. There is also something called a liquid CD. A liquid CD allows you to remove money prior to the maturity date without paying a penalty. However, you would be getting a lower interest rate or lower yield in exchange for that courtesy of being able to remove some or all of your money. It depends upon what the agreement is with the bank. Let's go ahead and talk about brokered CDs. Brokered CDs are actually offered by brokerage companies such as Fidelity, Charles Schwab, Vanguard, and multiple other brokerages. Now, the thing that is different about these brokered CDs is that the brokerage company actually goes and purchases the CD from a bank, and then they distribute essentially shares of that CD to customers. Why would they do this? Well, it's potentially one way of bringing in new customers, because they can actually offer a little higher annual percentage yield than a bank CD, because they're getting better terms from the bank because of the large volume of money that they can deposit. I already mentioned one of the pros, and that is a higher annual percentage yield. Here are some other additional benefits to a brokered CD. One can be diversification. Instead of having to go to multiple banks to buy multiple CDs, you can actually buy a variety of CDs from different banks within one brokerage account from your brokerage holder. You can also withdraw that money at any time. The way that you would do that is you can actually sell your brokered CD on the secondary market. In this way, it acts much like a bond. We'll talk more about that in just a few moments. The cons. You need to know that technically it is not FDIC insured. By that I mean that you are buying this from a brokerage who is not FDIC insured. Nevertheless, as long as the brokerage has purchased this from an FDIC insured bank, it is essentially FDIC insured. You need to make sure that your brokered CD is a bank product and not a security. There are multiple types of brokered CDs. Make sure that this is a CD purchased from the bank by the brokerage house. Also know that brokered CDs can have some intermediary fees when you are purchasing or selling your brokered CD. Now let's go back to talking about being able to sell your brokered CD on the secondary market. I mentioned that in this case that acts much like a bond. With bonds, if you hold a current bond and interest rates or yields go up, the value of your bond will go down because somebody else can purchase a higher yielding bond. Similarly, with a brokered CD, if the yields rise, the value of your lower yielding brokerage CD will go down. In order to get somebody to purchase it, you will have to decrease the price in order to increase the yield for the purchaser of your brokered CD. One other disadvantage for brokered CDs is that they are potentially callable, meaning that if interest rates go down, that the brokerage who may have given you a 4% brokered CD and now interest rates are down to 2% can call in that CD, essentially just pay you off your money, and then they can resell another CD at a lower interest rate. We're going to finish up this discussion just with the yields now so that you can get an idea of what you can currently get. This is as of Wednesday, January 18th. You can go to this depositaccounts.com. I will leave a link to that in the notes below. This is a great site where you can compare, and as of Wednesday, January 18th, in this article written by Ken Tuman, you can get a great synopsis of what CD rates currently look like. Currently, you can expect a minimum of at least about 4%, and at many institutions that's approaching almost 5%, depending on the terms that you are going to use for your certificate of deposit. Let's just talk about the brokered CD rates. For new issue callable brokered CDs, the top 5-year rate is 3.9% at Fidelity and Vanguard. That is issued by UBS Bank USA. If you want to have a shorter term, such as a one-term CD, you can get 4.65% at Vanguard and 4.6% at Fidelity. I hope that this was informative for you. Again, iBond investors, if you are in this for yield and you don't have a fixed rate on your bond, you're looking potentially at 0% interest that you're going to start earning on May 1st. Of course, if you're wanting to sell your iBond, this could be a great time to do it, because after 3 months of earning 0%, when you sell your iBond, you're not going to lose any money that you have accrued. Share this type of information with a young person in your life. Get them using their money to their advantage early. That makes such a huge difference in what their financial success can look like later in life. Until next time, enjoy your investing.